Hello, my name is Ron Peel, and I'm a partner with Rubick Partners. And I'm going to take a few minutes and introduce you to our asset exchange program targeted to community banks who need to divest themselves of various non-performing assets. First of all, the agenda for the presentation will be a short discussion on who the participants are, a little bit about us, and then I'm going to give you a summary overview of what the transaction looks like. And then we're going to drill down and look at more closely at the assets that we purchase, what our preferences are. We're going to then look at what assets we're selling in the exchange. And then I'm going to use an example transaction to try to highlight the effect of the transaction on your bank. And then we're going to speak some about our view of what the benefits are for this transaction. Then we'll talk to you about what the next steps are should you decide you want to move forward. I will tell you that you will receive by email a copy of this presentation deck and a draft confidentiality agreement that we would ask you to execute should you move forward with this transaction. Rubick Partners is a private equity firm, and our principals have been engaged in the secondary loan market for institutional loans of all kinds for over 25 years. We've closed over 275 transactions valued at over $4 billion. So we've got a wealth of experience and a wide range of transactions involving loans and various other assets. Our niche, if you will, is to find creative solutions to use loan pools to assist community and regional banks in some of the activities that they need to do, particularly in this era, to deal with some non-performing assets. An overview of the transaction is sort of some pictures that I put up here, if you will. On one side is the bank, and they've got some non-performing assets, and that might be anything from single-family 1 to 4 to commercial properties that are half developed. And on our side, as part of Rubick, we're holders of various pools of reperforming 1 to 4 single-family mortgages, and we're going to talk more about the details about what all of those things are later. What we will do is we will enter into an agreement with the bank to acquire all or some of their non-performing assets that we would buy and take possession of, whether it's the non-accrual loans or REO, and divest the bank of those assets. We would then ask the bank to acquire a reperforming pool of 1 to 4 single-family mortgages, and I'm going to, as I said, I'm going to talk more about what those are and what their characteristics are in a minute. But that's about as simple a transaction as we can define. That's an overview for what happens, and it should suffice. What are the assets we purchase? Well, we're interested in REO for one thing. 1 to 4 single family is kind of a preference. We will look at multifamily and commercial. We're also interested in non-performing loans or non-accrual loans, if you will, that are secured by various real estate. Again, 1 to 4 single family or multifamily or commercial. And the status of those loans can be either performing, delinquent, or bankrupt. What we are offering is to purchase these assets at book value. In other words, we're going to take them off your books at the markdown value you've got them on there as in this exchange. The assets that the bank would buy would be a portfolio of reperforming single-family mortgages at par. The size of that portfolio will be determined by the composition of the assets, the non-performing assets that Rubick buys. So we would need to take a look at what those are. To look closer at that, we offer this example of what that exchange transaction might look like. If you see my heading here, the bank-owned non-performing assets are really grouped into the 3 categories: 1 to 4 single family, multifamily and commercial, and land. And I've arbitrarily decided that for this example, the bank has $2 million worth of each category, both in REO and in non-accrual loans down below. Then you can see what are our typical multiples. And I say typical in that the process will be, we will take a look at the details about what the assets are and make a final proposal on what the multiples would be. But generally speaking, they're going to be in the range of 4, 5, or 10 times for 1 to 4 single family, multifamily, commercial, or land correspondingly. Now you'll notice that the non-accrual loans for the same asset types are a little bit higher, particularly in the 1 to 4 and the multifamily. The reason for that is our ability to divest ourselves of those assets, turn around, put them back in the marketplace, is stymied more when they're non-accrual loans, because we got to go through the foreclosure process, presuming we do, to get back control of the collateral so that we can in fact sell it and recoup our investment. You'll also notice that land is a pretty onerous 10 to 1 multiple. And the reason for that is we actually are not that interested in land, and it's sort of priced accordingly. We would look at it, and there are certain types of land that we might have a higher interest in than just pure raw land. But that's to be seen, and you would see those kinds of variations in a proposal after we had reviewed what the specific assets were. The assets we sell, as I've mentioned a couple times, are 1 to 4 single family reperforming mortgages. Now, what do we mean by reperforming mortgages? Well, these are modified mortgages. These are mortgages that general characteristics are they're going to have the pool we offer you is going to have a 7+ month perfect pay history after modification. That means this borrower got in trouble, had his loan modified, and now has made perfect payments since that time for at least a 7-month period. You're going to see loans that have had their payment terms modified. Not all of them, perhaps all of them. They've had their interest rate modified. But even with that, you're going to see kind of a propensity of fixed rate loans as opposed to ARMs. But there'll be some ARMs. They typically are some ARMs. We expect you to see the pool to have a weighted average coupon of somewhere between 4.5 and 5.5 points. You're going to see some possible principal deferrals that have occurred. You're going to see that these loans are very seasoned. These people have been in their houses a weighted average amount of time of about 120 months. So they've been there 10 years. So we think that speaks well for their ability to continue to pay and continue to live in a house. When you look at our pools, you're going to see they're generally geographically dispersed. We've seen nationwide pools, but they may be regionalized. As a matter of fact, later I'm going to show you a pool we had that was in fact regionalized in the Southeast, so you can see that. Many of those loans have good potential for refinancing, and that can be a source of revenue. It can be a source of you turning these loans out of your portfolio and selling them back into Fannie Freddie or other sources that you may want to move them to. And I think you're going to see some loans where you need to have a sensitivity to the FICO scores are recovering FICO scores. In other words, I don't think they're the same as you would see a FICO score for a new origination. In other words, those people's FICO scores are pretty stable. These have got the potential to change and change for the better. And I'll speak more to that with this in a minute. These loans, and people say, where do you get them and where do they come from? And that's sort of what this chart's about. This is a chart done by the Office of the Comptroller of the Currency, and it speaks to the number of loans. These are not dollars in that red box. Those are numbers of loans that were modified in a month by month, year by year basis from 2008 to 2015. The thing I want to point out is that Of those loans that were modified, 71.2% of them are current, which means their payments are current. So of all those loans that modified, 71% of them are current. We are sourcing the loan pools that we're looking at out of the 71%. We're not sourcing them out of the ones that are 30 days, 90 days, 60, 90-day delinquent, foreclosure in process, or any of those. When you look at that number of loans, and it's like 1.9 million that are active at the end of last year or whenever that was set. Actually, this was a chart's a little old. It needs to be updated, but it was when it was active, it was almost 2 million loans. That's the equivalent of about $300 billion in performing modified mortgages. Now, where are they? Well, they are in Fannie Freddie. They're in all the major banks. They're in private equity companies. They're in servicers. They're in a variety of places. And they're in, quote, what I call the secondary market. And that's what we deal with, and that's the kind of source of where we're getting those things. As I mentioned in the earlier slide, the reference to FICO scores, and that these are not what you would normally think of as a FICO score for a new origination, which was a pretty stable thing. These are FICO scores for people who had a difficulty and had their loans modified. This is a chart that was done by the Vantage Score Company, and for those of you who don't know, Vantage Score is it's a joint venture between Equifax, TransUnion, and the other credit company to do the modeling to develop FICO scores, and that's what they do for a living. So they are the kind of genesis of credit scores for all the major credit sources. What you see here is a chart that's the result of research they've done about what impact you have when you do various things to your credit score. This one, and if you look at the second one up here, it says missed payment or default, and that's what happens when you modify your loan. In other words, you got behind payments, probably got it behind 60 days, maybe 90. Your credit score took a hit, and it took a major hit. Look at this number. It took a hit right at 50%. Then it says, okay, if you do that and you begin a process of recovering, how long does it take to recover your credit score? What we see here is that those credit scores for those kinds of impacts begin to get better at about 6 months, and they get dramatically better, and the curve goes exponential at about 1 year. So what we can sort of speculate on that is people have got modified scores, and we're getting them where they're current 6 months to a year, then generally they're on the upswing to improving their credit scores. So my contention is that their credit score is probably a little stronger than what it represents. Okay. I've taken the same chart and kind of marked a couple of bars in here to show you that what we're pulling from is this group of FICO scores. In other words, we're pulling from those people who in fact are improving and have been improving and would be anticipated to continue to improve. So we think we've got a credit score that's, as I said earlier, a little bit stronger than what it might represent in a new origination, actually considerably stronger, particularly when you consider the seasoning of the loan and the property. Okay. I'm going to move now to speak about an example portfolio, and I put this one up here. This is, in fact, a portfolio we had. Don't know if it's still alive, but it may be. But it's a $24 million portfolio. It's got 183 loans in it. It's got a coupon of 5.4%, and the other statistics are pretty self-explanatory, and you can see remaining term of 274 months and seasoning of 139 months. And on the right, you see the geographical distribution, and you can sort of see that this is a southeastern dominated pool. There are a few loans spread over into the Midwest and a couple up into Virginia and West Virginia. But other than that, they're Alabama, Florida, those states down there. So it's a pretty southeastern pool. When we get a pool like this, then we're challenged with what is the pool's value? And one of the immediate questions is, what is the risk in this pool? What's the credit risk? And I want to walk you quickly through kind of our logic in determining what that risk is. The first thing we do is we take that portfolio of 183 loans and we spread it over a matrix that's FICO score ranges down the left and loan to values across the top, ranges across the top. And we populate it then with where are the loans in this pool? Where do they exist? So this gives you a pretty good picture about what's in that pool. And you can look at that and kind of conclude that, wow, I need to go look at these that are way over to the right and these that are way to the left are probably pretty safe. And you can start reaching thoughts about what you might be looking at. But in order to really understand it, we take it a step further and go on a loan by loan basis and try to determine what exposure we have in that loan. And we do that with the following kind of a formula. We take the property value at its last appraisal or BPO, whatever the most recent value we have. We subtract 10% because we presume if we foreclose, we're going to lose some amount of that property value at that. We subtract another $5,000 for administrative costs, legal fees, whatever. It's going to cost us $5,000 to do that. And then we subtract the unpaid balance. If the resulting number is a negative, then we have an exposure in that loan. In other words, we have a deficiency in the loan to value that says we're going to lose this much money. And you see that distribution. So you can look at the bottom and it says for that for that $24 million pool, we could lose, if all the loans defaulted, we could lose $1.3 million. Okay. And that's in essence what it says. Our maximum projected loss at 100% default is $1.3 million. Well, at least now we've got kind of the one end of the risk thing. Now let's take it a step further and look at a little tighter look at that. And I'm going to use a thing that FICO and Vantage and some other people use called probability of default. And probability of default is a set of numbers that have been modeled and statistically provided that give you a percentage of default probability at a FICO score range. And you can see it in this column here. It goes from 19% down to 0.2%. And it's by range of FICO scores. So the concept is, if in the previous slide, I know I could lose, if this loan defaults, I could lose this much money on that loan. Well, what I want to know is what's the probability of that default in dollars. So what we do is we take the probability of default and multiply it by the number of dollars that are potentially exposed, and we end up with what we call a portfolio probability of default, which in this case is $72,804, as contrasted to the 1.3 million. That makes our probability of default about 0.3%. Now, I can just tell you that I believe mortgages in a nationwide pool of more, and I may not be the right number, but I'll say it anyway, and we can verify it. But I believe the nationwide mortgage default rate may be about 0.6 or 0.75 or somewhere in that range. So this pool has some risk. As we have identified, but we think we've done a reasonably competent job at defining what that risk is and see where it goes. Okay. All right. Now that we've done that, then in our transaction, if I can kind of bring us back to the what does our transaction look like, in addition to you buying the $24 million in this instance, in this example of incoming mortgage loans, we're going to provide you a credit enhancement facility of up to 2% of the portfolio. That means we're going to deposit at closing in your bank cash of 2% of the portfolio, or up to 2%. And we kind of look at what that risk and exposure is, and in the proposal we would make, we would tell you what that number would be. Against that 2% credit enhancement facility, you can write off any net loss that you have in the acquired mortgage portfolio for a period of 3 years. If after 3 years there's residual monies there, then we'd like for it to be returned. We actually think that we are, in fact, overkilling the statistical loss perspective and would expect that if that is true, then we'll get some money back. And that would be our intent, as this is certainly a profit center. Okay. So after we've done that, now we know what the transaction looks like. We're going to buy your loans and your REO, and we're going to do it at book value. And we're going to sell you a portfolio of performing loans at par. And we're going to give you a credit enhancement. Now what I want to do is kind of contrast those two alternatives, if you will. That is your non-performing assets against us getting a performing pool. And we've taken the liberty to do some accounting for you in order to do that. So if you look at my chart, you're going to see that I've kind of arbitrarily decided that you've got $2 million worth of OREO and $2 million worth of non-accrual loans. And that's the population we would be comparing to if we were to replace them. I look at what is your cost in dealing with those on an ongoing basis. And we estimated the following. We said it takes probably a person, maybe a little more than a person, to deal with that kind of OREO inventory and that kind of non-accrual inventory. So we've allocated a cost annually of $150,000 to manage that OREO and non-accruals. We've also allocated $100,000 in management costs in addition to personnel costs. And in other presentations, it's kind of an interesting thing. They say, well, you're double dipping. And I say, well, wait a minute. You've got people who are dealing with the OREO and a non-accrual, and that's what the personnel cost was about. But how much time is your management spending on these things because they exist in your bank? That is not a trivial number. In fact, I would challenge that you wouldn't be in the room listening to me if you weren't spending money on the non-accrual and non-performing assets. So it's there. We all know, and it's kind of the elephant in the room, that you're going to lose net interest revenue in the lost opportunity cost against whatever the outstanding dollar amounts of the OREO and non-accrual are. We're using 5% because that corresponds to the incoming pool's coupon rate, a little less, but it corresponds well enough for us to average. So we've done that at $200,000. So in the first year, we would anticipate losing $450,000 on that set of non-performing assets. We would then expect to sell $1 million of the OREO in our pro forma, which is half of it. And then we would sell none of the non-accrual because, as we all know, once you get it into non-accrual, then you start foreclosure, and that's about a year process, sometimes longer, depending on the state you're in. But that's a big process. So the ending balance for non-accrual and OREO at the end of the year is $3 million. Well, we continue to sell those until we end up at the end of 3 years with a remainder of $700,000 in non-accrual and OREO assets, and we spent $1.5 million managing and maintaining them. We do project a disposition cost of 10% when you sell these assets, and that generally is 6% for a broker fee and another 4% because you're paying taxes and insurance and those kinds of things, those kinds of expenses. We do not think those numbers are particularly, we think those numbers are probably particularly conservative, and you certainly would have a better feel for what your reality is in that world. Okay. So then, once we've kind of understood what that looks like, let's look at the incoming pool. So we buy a $24 million pool that's got in this case, a 5% coupon. And if you'll recall, our $24 million pool example had a credit loss rate of 0.3. We're going to use 0.75 in here. But we are going to give you the 2% credit enhancement, which is $480,000 in a cash deposit. As we look at the movement through year 1, 2, and 3, we see we get interest income of obviously $1.2 million. We're going to have credit losses of $180,000, but they're going to be covered by the $180,000 we're going to take from the credit enhancement. So our net revenue or net income, if you will, is going to be 1.2 million. We're going to reduce the pool size by what number of loans we think we lost in the credit losses and do the same math. And we're going to end up with $1.1 million in revenue in year 2 and $1.1 million in year 3. For a total revenue over the 3-year period of about $3.4 million, contrasted to a loss of $1.5 million. At that juncture, I would contend we have a rather commanding, that's not the right word I'm looking for. I'm sorry, my mind just went blank, but a very strong benefit of what the benefit is to the bank on a cumulative basis. It was $4.9 million, almost $5 million. Compelling is the word I was looking for. It's a very compelling result that causes us to look at that. Even if you look at year one, you either make 1.2 million or you lose 550,000. You've got $1.7 million swing to your bank's bottom line. I contend that those are in fact compelling numbers that deserve your consideration when you're looking at that. I will add one more dimension, and I'll go back to my sample pool where I had a 0.3 loss ratio. Back before that, I had a loss ratio of $1.3 million if I lost 100% of the incoming pool. I wanted to know, what do I have to do if I buy that incoming pool? How bad would it have to be in order to break even with doing nothing or keeping the non-performing assets? And the answer is I would have to lose 9.3% of the pool to get within $2,000 of being the same result as if I had kept the non-performing assets. Well, that's kind of interesting because that would mean I lost $2.2 million in credit losses, when in fact we know that in the pool we were using as an example, if you lost more than 1.3 million, it wouldn't be possible, because you lost the whole pool. It wouldn't be but 1.3 million. So it again adds to the compelling factor about this is a very, very strong way for you to rid your bank of assets that are sitting there continuing to eat your profits and your management and your personnel time, and to replace it with assets that are in fact performing and will be very accretive to your income statement. To kind of summarize the transaction, and I think you see what it is now, and what it does is it lets you get rid of your non-performing assets at an attractive price. Well, book value, that may not be considered an attractive price, but I contend it is an attractive price when you're facing the continued losses that we outlined in the previous slides. So we think that is a compelling reason to sell those assets. We do not deal with, but we expect that you will benefit from, collaterally, I guess, the recovery of any specific or general reserves that you get on those sold distressed assets. So those will be recovered. I know for non-accrual, they can be pretty significant. For the REO, they probably are some, but not many. I don't know. There may not be. They may be there at whatever you've written them down to. You also are going to reduce your labor to manage the non-performing assets. And I say labor, and that's got the connotation of kind of workers, and that is true. But I would say that it may be more strategically important that you get it out of your management's hair and let them get on with running a bank and making money. And that may be the bigger benefit that's kind of gone unquantified, if you will, other than our estimate of management cost in there. Increasing your your earning assets and interest income has got to be what your CEO wakes up trying to do every day. So this certainly fits in that set of objectives and go. We even take the sting, if you will, out of whatever potential losses you might experience with the incoming pool by giving you a credit enhancement, and we think that is also a strong characteristic. So with that, that's about all the information I can share with you. I can certainly answer questions and would be glad to. And I'll give you contact information later, and you're free to call me. Would happy to hear from you. There are some other issues like due diligence topics where, depending on what kind of a community bank you are, where you are, all of those things like policy compliance, we can recommend consultants to help you with that. We don't have a quote dog in that hunt, but we can in fact give you some people that we know are quite competent to do that. The same with servicing. You may want to buy these incoming loans and put them in your portfolio and manage them, or you may want to leave the servicing where it is, or you may want to move it to a competent servicer who does a good job that you know of or that we recommend for you. So we can assist with those things. Generally, the CFOs have got to look at this transaction and determine a valuation. We will give you a copy of our discounted cash flow model that goes with that loan file. And certainly we're not trying to give you an evaluation. We're giving you our data. You do with it as you see fit. If you need an outside service, we have used the services of Crowe Horwath Valuation Services on the West Coast. Daniel McConaughey is an excellent consultant who is well versed in doing exactly what this is, valuing pools, and can be a help with you. Again, we don't have an interest in these companies. We merely point that out as a service and a convenience. Okay. If you look at this and go back and think about it and talk about it and decide you want to move forward, the next steps are kind of these. We would execute a mutual confidentiality agreement. I believe I mentioned earlier that we would have sent you one by email and a copy of this slide deck. We would ask you to give us a list of and information on, like, what's the story if it's a loan, and what's the appraisal if it's an REO, so that we can review those distressed assets. We would then do that and come back and say, we think we can do a transaction that looks like this with an incoming pool. And then we would get if we agreed, then we would get an incoming pool for you to review. Once you've reviewed it on kind of a summary level at an Excel file level, then we would say, okay, then let's try to mutually agreed upon term sheet to move into due diligence. And then we would each do our due diligence, us of the non-performing assets, and you or your appointee of the incoming residential loans. It's two transactions, so we have two sets of contracts, one to buy your loans and non-performing assets, and the other is for you to buy our pool of loans. It is all closed through escrow simultaneously. No money moves hands until it all moves, and it's all done. So it all closes one day, and all the money's wire transferred, and everybody's finished and happy. And then, obviously, we close. We've done these in as few as a couple of weeks. That's rare and usually a small transaction, and normally as long as a couple of months to get through all of the steps that are required to do that. We welcome your questions and would welcome your interest and would look forward to hearing from you. Here is the contact information for our principal people, myself, Ron Peel, my two partners, Bruce Riddle and Mark Groshy, and Tyler Dubusky, who's one of our lead sales guys who's out talking to people like yourselves and others. So with that, I would like to thank you for your time and look forward to hearing from you. And have a good day.